This analysis report details why Intuitive Machines, or LUNR, stock is positioned for 100% potential gains.
A bold claim.
It is, and it's driven by a major corporate acquisition and an imminent multi-billion-dollar NASA contract decision. The material makes a really strong case by identifying two massive explosive catalysts.
And that identification is, I think, the analysis report's greatest strength right out of the gate.
Yeah.
It's clear the writer has done the deep work here. They've spotted the two key drivers, the LUNR acquisition and the LTV pursuit that could just fundamentally change the company's entire valuation.
But, to really maximize the power of this strong buy alert, we need to show the reader how these massive elements interact, rather than just letting them run parallel. So let's start right there. Our first opportunity is this: the relationship between the LUNR acquisition and the upcoming NASA Lunar Terrain Vehicle decision, the LTV. It needs a much clearer integrated narrative.
Exactly. Right now, the material correctly says, the LUNR acquisition, that's $800 million for Maxar Space Systems. It's the event that turns Lunar into a space prime.
Right, with over $850 million in combined revenue.
And then separately, it identifies that imminent LTV contract, worth up to, $4.6 billion, as the primary catalyst, the thing that leads to the 100% gain.
Okay, I see what you're getting at. Both are powerful, no doubt, but they feel like two different, huge trains running on parallel tracks.
That's the weakness.
And the reader has to just sort of assume they're both going to help the stock price?
That is the weakness. Precisely. It treats the acquisition and the LTV pursuit as two separate events, instead of showing how the acquisition strategically strengthens LUNR's competitiveness for the LTV contract.
Or justifies the valuation even if they don't get the LTV win.
Yes, exactly. And that separation, it creates a sense of binary risk for the reader. Will they win LTV or not? That one decision shouldn't be the entire foundation for a strong buy.
I think the biggest risk in that separation is that if they miss the LTV contract, the reader assumes the whole investment thesis just collapses.
It collapses, even though the company is fundamentally stronger post-acquisition.
Right.
So the suggestion is to reframe the acquisition. Fundamentally, we need to position it not just as a revenue generator, but as the foundational element that makes LUNR the most credible LTV contender.
And that mitigates that binary risk.
It does. It has to look like a highly strategic, calculated move designed specifically to win this LTV bid.
That's a powerful distinction. It shifts the narrative from, LUNR is now big to LUNR is now the only qualified candidate. So how can the writer make that concrete?
Well, one way is to move beyond just listing the combined revenue, the $850 million.
Okay.
Instead, explicitly frame this massive scale, this space prime status, as satisfying the institutional requirements, the due diligence benchmarks NASA needs to award a multi-billion-dollar 13-year contract like the LTV.
I like that, but what does being a space prime actually mean in this context?
Well, a space prime is basically a Tier 1 contractor. It means a company is large enough with the right infrastructure and financial backing that an agency like NASA sees them as capable of managing these huge, multi-year projects without, failing or going broke halfway through. And when you're up against smaller outfits like Lunar Outpost or Venturi Astrolab, the analysis has to hammer home that this revenue base and stability makes LUNR the only real competitor that can handle a contract of this size.
So the acquisition becomes the logical prerequisite, not just some nice bonus.
It is. And furthermore, the analysis notes that LUNR brings deep space infrastructure capability.
Right.
The material should suggest linking that newfound infrastructure directly to LUNR's existing lunar expertise. Show the reader how the combined company's offering would technically, operationally, just surpass its smaller competitors.
So not just financially, but in actual capability.
Exactly. Making the LTV win seem highly probable.
And what about that risk mitigation piece? That's so important for a high-risk stock like this. How do we use LUNR to de-risk the investment if they miss the contract?
The analysis could position the acquisition as the move that de-risks LUNR's entire portfolio. It provides substantial, stable, non-lunar government revenue, satellite manufacturing, deep space comms, things like that.
So that $850 million combined revenue is weighted towards stable contracts?
That becomes the true baseline value. It makes the stock fundamentally valuable even if the LTV contract is missed. And that turns the LTV win into an additional massive kicker, not the only reason to invest.
That makes the argument so much more compelling. We're moving from two separate catalysts to one unified de-risked investment thesis. Okay, let's talk about the valuation itself. Our next core opportunity is establishing a robust floor valuation to support the strong buy thesis.
A critical next step. The core issue is grounding this investment decision in something tangible, in fundamental value, not just news-driven volatility.
The analysis does acknowledge the IM2 tipover incident, and it concludes the downside is already priced in, citing that $9 level as the crucial point to watch. And the writer wisely includes that the company ended Q3 with, $622 million in cash and had Q3 revenue of $52.4 million.
But here's the weakness. The dismissal of the IM2 issue, it relies purely on a general market assumption, that phrase, priced in. It doesn't leverage that crucial financial data.
The cash, the revenue.
Exactly. It doesn't use it to quantify the intrinsic value floor. They tell us the risk is gone, but they don't prove it with the numbers.
So the reader is just left trusting the author that $9 is a good price, rather than being shown why it's fundamentally attractive based on the assets and the new business.
Yeah, they need hard proof that the risk isn't just, sentimental. If this is a high-conviction, strong buy at $9, the analysis needs to clearly establish a new base value for the combined company. This base value has to demonstrate that the intrinsic value justifies the $9 share price, even before you assign any speculative value to the LTV contract.
This is where we shift from narrative to pure math.
It is.
Let's give some concrete examples for how to calculate this new floor, starting with the cash.
First, you use that huge cash reserve. Take the $622 million in Q3 cash and calculate a clear cash per share metric. It's straightforward. Cash divided by shares outstanding.
Okay.
Show the reader exactly how much of the current $9 share price is backed by cold, hard cash on the books. That immediately differentiates LUNR from these early-stage growth companies that are just burning capital constantly.
I can see that being a powerful defense against a high-risk label. If, say, $3 of the $9 share price is just cash.
Then the remaining $6 is buying a company with $850 million in revenue potential.
Right.
Precisely. Now, let's address the new revenue from the acquisition. The analysis should suggest applying a very conservative industry multiple, say 1x or maybe 1.5x, to that new projected annual revenue of $850 million post-close.
So why a conservative multiple?
Because the goal here is not to hit the target price of $18. The goal is to establish the floor.
Oh, okay.
By using a conservative multiple, the analysis can demonstrate a baseline enterprise value that inherently supports the $9 price, independent of the LTV catalyst. If the core business, conservatively valued, already justifies a price of, say, 8 or 10 money to how much money am I going to make?
I like that.
Right now, the risk-reward is sort of framed as $9 risk to $18 reward. The suggestion is to represent that. It's not 9 to 18. It's X dollar risk, that new calculated floor. Maybe it's $6 or $7 to 18. That transforms the high-reward, low-risk aspect into a concrete metric.
That makes the whole thing feel incredibly robust. Okay, now, let's pivot to the immediate opportunity. We are talking about 100% potential gains tied to a decision that could drop any day. So our final, crucial point is sharpening the imminent catalyst timeline for maximum reader urgency.
Absolutely. The material stresses the LTV decision is expected by the end of this year.
In a late November context, yeah.
Right, and it notes the volatility will be insane, and the target is $15.50 to $18. The facts are solid, but the execution of that urgency, it just needs to be undeniable.
The weakness is in the language. Vague timelines like end of this year or any day now, they dilute the specific, immediate call to action you need for a high conviction, strong buy.
Especially one tied to a binary event that could happen within weeks.
Exactly.
The analysis needs to define that strategic window much more sharply. Is there a risk that end of year makes readers think they have weeks when really the window could close in days?
So the suggestion is to focus the ending strategy on the rapid, violent market movement you'd expect on the announcement.
Yes. Transform that uncertainty into a clear, time-sensitive opportunity that justifies immediate attention.
So how do we take that generic sense of volatility and turn it into a specific command?
Well, instead of waiting for the conclusion, you integrate the volatility potential, that jump from $9 to potentially $18, directly into the discussion of the LTV catalyst itself. Frame the current $9 price as the absolute last chance entry point before the market prices in the outcome. That immediately heightens the stakes and justifies the rating.
That makes the urgency thematic throughout the whole back half of the report, not just the reminder at the end.
And you can also give concrete detail on market behavior. The analysis should briefly detail how the market reacts to major contract wins in this sector.
You mean immediate pre-market or after-hours surges?
Yes, often before the general market even opens, or most retail investors are even awake. It illustrates the reality that waiting for confirmed news means missing the primary defining move from $9 to $15.50.
You cannot wait for the press release.
You have to be positioned now.
That's a sophisticated observation. It empowers the reader to understand why they have to act before the news to capture those 100% gains.
And finally, you make sure the strategy section clearly links monitoring the LTV decision to the specific analyst targets. Emphasize that hitting those Wall Street targets of $15.50 or $18 is completely dependent on capturing that immediate, imminent volatility. The goal is to get in before the massive shift, not after.
This analysis report has strong bones. It's powered by 2 explosive catalysts, leading to this massive 100% gain potential. But to turn it into a truly unassailable strong buy thesis, we've identified 3 core actionable opportunities.
That's right. First, you have to integrate the LUNR's space prime status not just as a revenue bump, but as a clear, logical story element that strategically strengthens the LTV bid.
Providing NASA with the scale and confidence it needs?
Exactly. Second, quantify the intrinsic value floor. Use that $622 million in cash and the $850 million in combined revenue to prove mathematically that the downside risk is genuinely priced in. This changes the whole risk-reward equation. And finally, sharpen the LTV catalyst discussion to maximize urgency. Move beyond general timelines and emphasize the rapid, imminent volatility that defines this opportunity.